And welcome to a China Mining Club video blog, and I'm delighted to have the chairman of NQ Minerals, David Lenigas. David, hello.
Yeah, no, ni hao, Andrew.
Very good, fluent Chinese. Now, NQ Minerals, you're based down in Tasmania. You've got two main assets, the Helier mine and the Beaconsfield gold mine. Why don't you give us a quick talk through your key points of your presentation?
Yeah, thank you, Andrew. Look, we're a London-listed company. Our assets are in Australia. We are also listed on the American OTC market. We have two ticker symbols there. We have NQMLF, which is the 1 for 1, which is starting to trade quite actively. And we also have a 1 for 100 ADR, which trades at about $15. And that's new. We're the first Aquis company ever to have a listed ADR on the US OTC markets. So so we're a London company with Australian assets. We have, if you're going to be putting the slides up on this, Andrew, I hear. So slide 4 is a summary of what we have. We have 1.3 million ounces of gold on our reserve resource base, 31 million ounces of silver, and 1/3 million tons of lead and zinc metal within our reserve and resource inventory. We have one mine in operation, which is the big Helier mine in Tasmania, which produces lead and zinc concentrate. Most of that goes off to the Chinese smelters. We've just increased production by about 50% in July, and we're looking at another increase in production by probably closer to 25 to 30%, hopefully by the end of the year. So our Helier operations are going very well. That's a good 10-year mine life. And from an exciting perspective, we've just acquired the rich historic Beaconsfield gold mine, also in Tasmania, which has had historic production of around about 2 million ounces over the last 150 years at nearly half an ounce to the ton. And we're starting off production hopefully by the end of the year, and we have in front of us already around about 500,000 ounces at 1/3 of an ounce to the ton resource grade. So that's going to be very exciting for us and add a lot of revenue to the top co of the company. So that's NQ in summary. If you look at slide 6, we have at Helier, we've got 760,000 ounces in the reserves of gold, 27 million ounces of silver, 276,000 tons of lead metal, and 217,000 tons of zinc metal in our current operations, which is running at around about 1.3 million tons a year. We've got a 10-year mine life. If you add up the in-ground value of that inventory, it's a hell of a lot of money. It's in the billions. And we've finally managed to get that project going to where we're happy with its performance, recoveries, and we have very good offtake partners in Traxys, which is a big Luxembourg trading group. And as I said earlier, most of our concentrates of lead and zinc end up in Chinese smelters. We've got a very good relationship there. We have firm offtake agreements with Traxys and buyers in China and elsewhere until 2024. And when we restructure the corporate debt that we put in place to start this operation, hopefully in the coming weeks, if not months, with ING Bank for a tune of about $55 million US, we'll have a firm offtake partnership arrangement with Traxys through to 2030. And
maybe I'll just pick you up. Maybe I'll just pick you up on that point. I'm not sure in the presentation you have a slide on your debt, but you have a market cap, I believe, of about £35 million today. And yet clearly with the amount of production you've got, you'd think it would be much higher, but you do have a lot of debt, don't you? And it's quite high interest debt. So just restructuring that debt alone will have a massive impact on the company, won't it?
Yeah, look, the debt that was put into place to start Helier, to acquire Helier and put it into production, is around about $100 million US in total. But that's not extraordinary for a project of this size. Most new mining projects have debt, but this was pre-production debt, so therefore it was quite risky, and that sort of averages about 13% per annum interest rate. So by restructuring half of the debt with ING Bank down to a more commercial 6.5%, it adds a lot of money to our bottom line revenue and sort of stretches out our debt profile to match the performance profile. So it'll have a big impact on us. And then with respect to recovering or paying back the balance of the debt, that's why the Beaconsfield gold mine's important. because that project operating at full capacity, sort of circa 2021-22, will give us a lot of surplus cash, and that puts the company in a very good position. But you're right, Andrew. With a market cap of 30 million pounds, circa 40 million US dollars, the reason why that is principally because we're trading on the lower market here in London, and the liquidity is, as you know, is quite limited, which is why we've sort of initiated the concept of focusing on getting our US listing working. And from Chinese investors' perspective, a lot of Chinese would find it easier to trade the US OTC markets than they would the London Aquis market. But to also address that, we're working very hard with our lawyers and our consultants to move NQ to the main board. And I think once we get on the main board, our whole liquidity, volume, and market cap will appreciate quite significantly. And current timing for that is either end of October or sometime in November this year. COVID-19 depending, because people aren't necessarily working flat out from their offices. So there's a three-pronged approach here from NQ. One is to restructure the debt, which we've all been working on feverishly for the last few months, which hopefully we'll see bear fruit for us in the coming weeks. The other focus is to lift production at Helier and get our Beaconsfield operation into gold production as soon as possible, hopefully by the end of the year. And the third prong of the whole strategy is to move NQ to a more liquid exchange that the world finds it easier to trade NQ shares on. So that's really the strategy.
Let's just focus on Beaconsfield again. You've explained Helier, nice producing mine, generating cash flow. Beaconsfield comes along and obviously could be a world-class gold asset. Do you want to just explain what you think you've got in the Beaconsfield mine? Because obviously it's a historic mine that's been mined before, and so there's a lot of information.
Well, yeah, I mean, the mine is not new to the world. I mean, it became very famous in 2006 when two miners got trapped underground. They call it the Anzac Day disaster, 2006, got trapped underground for 2 weeks and they were rescued. Sadly, one person lost his life, and that was due to a rock fall. But we have, I mean, if you go to page, where are we? Page 11 on our presentation, we have a fully functioning permitted treatment plant rated at 350,000 tonnes a year. We have fully permitted tailings dams. The government of Tasmania has been extremely helpful because it's a jobs driver for the northern part of Tasmania. And our team is working actively to bring the plant into gold pouring mode by the end of the year. Historically, Beaconsfield, in the later phases of mining from 1999 to 2012, was a good 80 to 100,000 ounce a year producer. But more importantly, it's about the profit. I mean, when the mine closed in 2012, its operating cost was still only 1,000 Australian dollars a tonne. If you look at today's price, well, in US dollar terms, $700 an ounce. But the gold price fell that much that they couldn't keep the mine going. So the plan is to bring the plant into operation. There is plenty of ore at surface that we can start the plant off with in very profitable mode. We're just working out our final budgets on that. And then we're looking at putting a new access into the mine to access the 500,000 ounces of high-grade resources and reserves that sit down the bottom, and then bring the mine back into full-scale production. But if with a break-even cost of sub $1,000 an ounce, and the reason why that is because it's very rich. At $2,000 an ounce, this is a very profitable operation. And already we've got 5-6 years in front of ourselves, and the ore body's open at depth. It's very much like the Fosterville mine that Kirkland Lake have across the water in Victoria. This is a mesotherm type deposit and will last for kilometres in depth. And when you look at the grade of Beaconsfield, there's been nearly 2 million ounces come out of that project. There's still a lot of ounces left, and there's no reason why it couldn't be 2 or 3 times that amount of ounces by the time the mine's exhausted. So this thing's a long life, very highly profitable asset.
I mean, as you say, our own geologist knows it well, and he also, like you, is very upbeat about Beaconsfield. Just quickly, David, I mean, you do have a few little fairly sort of speculative projects up in Queensland as well. Do you want to just quickly explain what they are?
Yeah, well, these were the original assets within NQ. You know, they're called Eucalyptus and Square Post, and you know, very high grade gold, very high grade silver, base metals. They're more development exploration plays. What I can tell you is we're getting a lot of interest from Australian players, including some Australian majors who see some significant potential in this. From NQ's perspective, it's probably now not our biggest priority. Right now, we're focusing on generating cash and cash flow from our main operations. But you know, they're certainly worth something to the company as we move forward. And you know, if we get an offer that's too good to refuse from a joint venture participant from one of the big companies in the area, we'll certainly look at it.
So anybody who's interested in nickel and cobalt, which is just about everybody, in particular the Chinese at the moment, should give you a call.
Well, no, the nickel and cobalt's in Tasmania. That's called our Barnes Hill project, and that's got you know, 141,000. And if we look at slide, where are we? You know, yeah, it's a slide above that. Yeah,
next slide, yeah. Sorry, it was my, yeah.
Yeah, we're looking at slide 14. You know, we've got 147,000 tonnes of nickel metal and 11,000 tonnes of cobalt already drilled up and defined at Barnes Hill. I mean, not that it's sort of a relative way of looking at things, but you know, there's $2.5 billion worth of contained nickel and cobalt in Barnes Hill, and it sits right next to our Beaconsfield operation, so we can share in things like infrastructure and management and things like that. So we're currently producing the pre-feasibility study at the moment, with the view that this could potentially be one of the lowest cost nickel producers in the world, because we can use the sulfides that Helia produces to produce very low cost sulfuric acid. So yeah, we're pretty excited about that, and that's project probably number 3 for us once we get Beaconsfield up and running.
But I think you'd probably still be interested in a telephone call just to, even if somebody wanted the offtake, help you get it into production.
Well, you know, that offtake isn't locked in yet. So you know, our offtake from Helia is locked in for life of mine. But certainly we're open to discussions with potential off-takers or partners in Barnes Hill for sure.
Yeah, yeah. My apologies that I was jumping onto the next project before I'd finished the Queensland Gold project. Just too excited about what's going on. That's great to talk to you, David. I mean, are there any, I mean, in sort of summary, basically, you know, you've got a existing well-known mines, resources are there. You've got production, you've got development, you're restructuring your debt. It all looks pretty good, but you're an entrepreneur and always open to interesting deals that can help add shareholder value.
Well, yeah, I mean, we get a lot of approaches from Chinese companies wanting to actually buy the whole company. But, you know, COVID sort of slows things down a bit there. China is certainly the place that's very interested in what we're doing, mainly because, you know, of our Australian jurisdiction with respect to mining. Australia is a good place for mining assets and projects. But you know, our real focus is getting shareholder value here by moving NQ from the Aquis Stock Exchange to the main board. And you know, I think with the main board, you know, from my experience, and Andrew, you've known me for a long time, you know, I've raised a lot of money out of the big New York and European and Asian funds. Most fund managers can't trade Aquis. But the moment you're listed on a main board stock exchange, they can all trade you. So that's a really big push for me. And I think that's the signal to me that that we'll get true value in what I believe is a terribly undervalued stock. And I don't think we're going to have to wait too far for that. So people who are prepared to take a punt that I'll actually get this and the team will actually get this move to the main board within the coming months, that's where I think there's some good leverage here. And you know, from China's perspective, China actively trades the OTC markets. Very difficult to trade Aquis. So you know, call your broker, ask questions, do your research. I think we're a good punt.
Very good, David. I think you're quite a good long-term investment as well as a punt. So great to talk to you, and I hope everybody enjoys listening to this presentation. Thank you, David.
Right. Share.